Good afternoon. Equifax is pleased to welcome you to today's webinar, the Q1 U.S. Economic and Credit Trends Outlook. My name is Teresa Fries, Senior Director of Portfolio Marketing at Equifax and your host for today's webinar. On behalf of the entire team at Equifax, I want to thank you all for attending. If you are joining us for the first time today, our goal for this webinar series is to deliver timely insights on the economy and key trends in consumer credit that can help drive strategic growth at your organization. Whether you're looking to benchmark your company against the national market, better forecast your book of business, or monitor shifts in the economy and industry in general, we are sure you'll find value in the insights delivered today. Please note that today's call is being recorded and all participant lines will be muted during this broadcast. This presentation is scheduled to last 1 hour. There's a lot of content to cover this quarter, so we may be limited on time for questions. However, please feel free to submit a question at any time by typing it into the chat box at the lower left corner of your screen and clicking the send button. As is our custom, we will send a follow-up email with responses to all questions in an FAQ format in about 2 weeks. This webinar will be available for replay, and you should receive a follow-up email with a link to the recording in about 24 hours. Over the next hour, this webinar will include an overview of the U.S. economy with an update on consensus forecasts, potential tax cut implications, and additional high-level macro trends impacting the U.S. economy. We'll also go over U.S. consumer credit trends, the overall trends in consumer credit, as well as debt outstanding and origination trends for key trade lines. Our special report section this quarter is on early payment performance. A good barometer for lending standards, we'll take a deeper dive into current vintages to assess payment performance and defaults for key trade lines. As you know, we present on a different topic in our special report section each quarter. Past quarters have focused on recession outlook and credit tightening, and at the end of today's webinar, you'll have an opportunity to suggest a topic for an upcoming webinar. We encourage you to take a moment to share your recommendations with us at that time. At this time, it is my pleasure to introduce today's speakers. Our first presenter is Amy Cruz-Cutts, Senior Vice President and Chief Economist at Equifax. Amy is a recognized industry expert with over 25 years of economic analysis and policy development experience. As Equifax Chief Economist, she is responsible for analytics and research relating to the consumer wallet, assets, income, credit, and spending, along with macroeconomic factors affecting the consumer. Amy is also responsible for macroeconomic forecasting and the economic analysis of employment and wage trends, home equity, and real property, as well as small business credit trends. Also joining us today is Gunnar Blitz, Deputy Chief Economist at Equifax. Before assuming his current role, Gunnar led customer analytics for the Equifax mortgage vertical. Prior to joining Equifax, he was a senior research analyst performing analysis around modeling mortgage prepayment and default risk, creation of a short-term prepayment scoring system for marketing applications, and custom property and mortgage analytics for academic research. In previous roles, he provided consulting and customer relationship management modeling in the banking, insurance, telecommunications, and travel verticals. And with that, I will turn the presentation over to Amy and Gunnar. Amy?
Thank you, Teresa. It's always a pleasure to have you join us on these webinars, and we deeply appreciate your support here. I'm going to kick off here with a little broad overview of macroeconomic trends that keep me up at night or otherwise reading the newspapers. I want to kick off actually with a talk about interest rates because I've been seeing more and more reports in the newspapers and on the talk shows about an inverted yield curve. And I think we're premature to really talk about an inverted yield curve because, well, it isn't here yet. Clearly, the spreads are tightening as the Fed has both embarked on a presentation, a change in what they're doing regarding the setting of the target interest rate, which targets really short-term interest rates, and the changes they're making in their portfolio through the unwinding of the quantitative easing. Specifically speaking to that, one of the points that I found underrepresented in the discussions about what the Fed is doing is that when portions of their Treasury security portfolio mature, they are replacing any long-term bonds that mature with short-term bonds. So they are shortening their interaction in the marketplace with the intention to raise long-term rates. I don't want to say aggressively because right now there's such a small amount of runoff in the portfolio that's allowed. It's $12 billion a month in this quarter. But that's part of their intention there is to raise the long-term yields, which is part of what they targeted in quantitative easing. But then when they raise the target rate, they're affecting the short-term rates. So kind of in tandem, both of those policies are designed to raise short and long-term rates. The other thing I wanted to highlight is that, as economists and econometricians, we like to look at data to try and discern from the tea leaves what's coming next. And inverted yield curves, where short-term Treasury bond rates exceed the long-term Treasury bond rates, do tend to precede recession. Sometimes they precede the recession immediately prior, and sometimes they precede the recession quite a ways back. The average over this period here since 1955 is that the onset of the inverted yield curve predates the recession by 17 months. So if this is the barometer that you want to look at, we're a minimum of 18 months out from a recession because the yield curve hasn't inverted yet, going on the basis of that average run. Additionally, I think that the likelihood of recession has decreased further with the addition of the Tax Cuts and Jobs Act. With the stimulus that's provided from that, which is quite massive, I think that any recessionary pressures have been reduced. They're not zero, but they've been reduced. And we see that in the Wall Street Journal survey of economists, that they've dropped their probability a point or two from what it previously was, and it's been hovering around 16 to 18% for a while now. So again, no one is currently forecasting any imminent demise to this very long run for the expansion. And you can see here in this chart too that the expansion from 1961 until 1970 was the longest post-war expansion cycle that we had. The 1991 and 2000 perhaps is a little bit longer, but those are the two longest. Right now, we are within just a few months of taking over the longest post-war expansion period. So that'll at least be a good record that we set. Okay. The phrase that sort of the idiomatic phrase that enters in so often now, again in economic discussions, is that we are at full employment because the unemployment rate is low. This one just makes me twitch because while it's true that we are at an unemployment rate that is the lowest that we've been in a very long time. There is a record below this, but in this particular chart, I'm looking at the unemployed to population ratio, not the unemployment ratio that's published, which is the number of unemployed over the number of unemployed plus those who have jobs, which is the labor force. This one looks at the population, adult population, 16 years old and older, and there we're really at the low point over this history. We can take it back further. This is as far back as I went. That's nice, but I don't think it tells the whole story. And I think, the second piece of the story is to look at the employment to population ratio. And I think this goes a long way to explain why wages, until very recently, have not really been keeping pace with inflation even. There's large segments of the population that really have not received a meaningful raise since 1970. And by that I mean a real, meaning inflation-adjusted increase in their payments, that they still are falling behind inflation. So minimum wage is clearly one example of that. So what about this employment to population ratio? What's the missing link? And that's the lack of participation in the marketplace, that so many people have withdrawn from the labor market altogether. some of them are on permanent disability, and certainly during times of economic stress, more people go on permanent disability when they just realize that they can't find a good job in that. I think, too, with much of the transition of our economy, that things are evolving away from sort of traditional fields, say, for example, in manufacturing and other areas, that we're really right now in a transition phase, and it's going to take a long time before the folks who, where we have the locational skills mismatch for people to move, additionally for people to gain the kind of training that they need that's meaningful in the next major employment cycle. So it's kind of an ugly period with respect to employment. I don't know when we're going to see this employment to population ratio back to kind of where it was prior to the last two recessions, but I think that goes a long way to saying while we have difficulty filling some particularly highly skilled jobs, broadly speaking, there's still considerable slack in the economy, and I think that's why the wages are not accelerating. We did get a little bit of good news that wages had, quote, surged all the way up to 3%. I think there's a broad swath of the economy that would love to see 3% be kind of the average raise that they get, but we're a long way from that. That came in just at the end of the year. I hope that momentum continues, but I'm not particularly optimistic that it will last long. Here's another way to look at it. This is from our friends at Oxford Economics. And let me back up one step here. Think about taking this point right here, and what they did was to take that very last point and decompose it along a couple of metrics. So the horizontal metric is metro employment to population ratio relative to that aggregate point on the prior slide. And then they looked at the percent of the population in the metro area that has at least a bachelor's degree. And then they looked at what the employment base is for that city. So the dark blue circles represent tech-heavy places. The gray is traditional manufacturing. The green is a housing bust city. Agriculture is in kind of that gold color. And then balanced economies with a wide employment base are in red. And we very clearly see that the tech-heavy sector has a very, very low, in a positive sense, a high population, employment to population ratio. So on the good side, with the tech-heavy and more the balanced side, whereas particularly agricultural cities have very high unemployment, thus, and low employment to population ratios. And so the housing bust has just been lasting. This started in 2006 when house prices stalled, and then the foreclosure started, and many of these cities just have not recovered. I was just out in Las Vegas, and they're still struggling to get kind of back to even a modest market there. Various areas have done a little bit better, depending on how, a city like Phoenix that is so heavily dependent on the university and some of the healthcare provided there has recovered somewhat faster. So anyway, I found this a very intriguing way to look at that decomposition, and I think that what we see here in that bottom left quadrant, that kind of more explains some of the lack of employment possibilities and how slow these cities are to regain their footing. Okay, another question that we get is the implications of some of the tax provisions. And I confess that the tax bill is massive. There are lots and lots of provisions that I have not even started to formulate ideas about. But this one in particular I thought was interesting, which was, will home equity lending die now that there's no tax deductibility of the interest? There were already several rules about the tax deductibility of second liens, and it had to do with what was paid for the house originally, and the total debt outstanding, and then the total limit on all the mortgages. So there's certain requirements there. But I wanted to take a look at here again. If you want to do a meaningful improvement on your home, my understanding, not a tax advisor, my understanding is that that would remain tax deductible. But in particular, I wanted to look here at an example of a homeowner who wants to pay her child's tuition by extracting home equity. She's got a lot of it, $300,000 of equity on a $600,000 home, and so a $300,000 balance on the existing first mortgage. Assuming that tuition will cost $75,000, she wants to take it all out now and make the payments over time. And she and her spouse, plan to itemize their taxes under the new law. And I chose the 24% marginal tax rate. It turns out that the results of my quick and dirty calculation don't matter based on that marginal tax rate. And then I'm going to assume that they have excellent credits because those are the easy rates to find online. So the question is, should she use a home equity loan or a cash-out refinance to finance the tuition or another form of borrowing? Again, a quick look at rates. Home equity loans, cash-out refinance is the cheapest way to finance large items these days. So, she could go through fintech. She could get a consumer finance loan from there or from a bank, put it on credit cards, those kinds of things, could take out student loans. All of those are much more expensive than if she's successful in getting a home equity loan or doing a cash-out refinance. Okay, so let's walk through the numbers. Cash-out refinance requires that you refinance the entire first lien, take out the additional $75,000, and then you have to pay closing costs. Closing costs are not, I add them in here just as a note, but I didn't put them in the totals. The closing costs would likely total about $6,000 for this borrower. And then the interest rate that you pay is higher than the rock bottom, whatever the rock bottom rate you would get for your credit and collateral that you have, the down payment. You have to add at least 25 basis points to the rate or more, depending on the charges that are levied by the mortgage backers, for example, Freddie Mac and Fannie Mae. To do a home equity installment loan, the rate that I found, this was in January, was 4.75%. And I did the calculation here on simple interest rather than taking into account amortization. Again, those are pretty trivial. Simple interest cost in 2018 on the first mortgage is $10,500. The new home equity installment loan, the interest that she would pay there is $3,500. And if she did a new cash-out refi first mortgage, the simple interest cost would be $16,875. Take into account then the 2018 deduction at the 24% marginal rate, and you get a bigger deduction on the cash-out refi than you would with the original first mortgage, and no deduction at all for the home equity loan. So that after tax, the 2018 total combined interest cost, if she goes the home equity route, is $11,500, which is less than the $12,825 that they would pay with the new cash-out loan. On a monthly payment basis, the before tax monthly principal and interest payment, the new cash-out refinance loan wins only a tiny bit, but not after you take into account the total payments, interest, and principal. So, and then lifetime. If you do the home equity loan and keep the existing first mortgage with 25 years left on it, total interest paid would be $144,000 versus $235,000. So by my estimate here, and again, the marginal tax rate didn't really matter, home equity loans still the cheapest way to go. Cash-out refinance still attractive for some borrowers. And, all these depend on individual circumstances. When we add in the fact that the standard deduction now has been doubled, many borrowers who previously itemized their taxes won't have any reason to now, which will make their tax preparation so much easier. So I think that, that wouldn't have an impact on those folks anyway if they didn't itemize previously. And, and the bottom line, taxes are complicated, but I think that the statement, sort of off the cuff that having these loans be non-tax deductible on the interest payments would kill off this form of lending, I think are premature. That I think this will certainly remain very viable It's still depressed relative to where it was, and I'll go through those numbers here in just a minute, prior to the Great Recession. But home equity lending does pose potential for homeowners who've developed quite a bit of equity. Okay, I'm going to walk you through total consumer debt and some of its sources. This has also been in the news quite a bit lately. Our good friends at the New York Federal Reserve, publish every quarter. We also release this information both monthly in our credit trends reports as well as quarterly in the publicly released credit trends reports on our investor relations website. We'll show you where at the end of this webinar where to get that information. But we've surpassed the prior peak. We did that in about, I think, August or September of last year. So in December of 2017, we hit $13.06 trillion in total outstanding consumer debt. In terms of inflation adjusted, after taking into account the impacts of inflation, even at 2%, that's 20% over this period of time, we're still well below. We are about 13% below the prior peak once we take into account inflation, so on inflation-adjusted numbers. And then if we were to add in population growth, so think of it in a real, not only real, but real per capita basis, and the per capita here being adults because children can't take out the loans, we're 20% below where we were on the prior peak. So I think consumers are doing quite well in their debt management. I don't have the slide in here, but the Fed makes available on the Board of Governors website and their data there the household obligations, financial obligations ratio, and those are still at near historical lows. Interest rates being what they are, still very low. Many households restructured their debt, reduced their debt, and with the very low interest payments today have financial obligations, the monthly required payments on the debt they hold are near all-time lows. So I still have a lot of confidence in the consumer sector and their ability to handle debt. I'm not saying everybody needs to go out and take out loans tomorrow, but I think that household balance sheets are in very, very good place relative to where we've seen in the past and even relative to where we were just a few years ago. However, the shape of the debt and the sources of the debt have changed dramatically. So first mortgages are still below where they were previously. We've got $8.7 trillion. They're the only ones pointing to the left axis. But that's down from the peak of where we were, about 3% below the previous peak. All of the other bar charts here point to the right axis. And you can see her home equity lines of credit, about $400 billion. Home equity loans are only $100 billion. I know those sound like big numbers, but spread them out over all the households, it's not so big. And down considerably, down 50% combined over where they were at the peak prior to the recession. Auto loans and leases are at new all-time highs. They're at $1.2 trillion. The loan terms on those have expanded, so now on a loan, the average and median term length is 5-6 years. Certainly up considerably, but the quality of cars today is so strong, and these cars really are lasting very, very long. Again, in 2017, the median age of cars on the road grew by 1/10 of a year, so they're up to 11.5 or 6 years now. 11.6, I think, is the number for last year. So still extending that out, even with all the cars that we bought. And so the terms of the loans and the assets are matching better and better over time. Credit cards have set an all-time high. Again, this is combined bank cards and retail cards. Again, $800 billion, but it's only a little bit of a change there from the prior peak. Consumer finance decreased dramatically at its low, and this low is defined as the 2010 to 2013 sort of the trough that happened from the recession. And they've climbed all the way out to $100 billion again, still very, very small in the grand scheme of things, but certainly has the potential for growing. And I know that there are many different paradigms out there for lenders that focus on consumer finance, whether it's banks or independent finance companies. The last one there is student loans, and this is the one that I find the most troubling, $1.4 trillion in debt. And The reason I find it troubling is not for those folks who go to a university, whether it's a community college or a technical school or a four-year institution, and graduate with a degree in a field that's in high demand. They're going to get jobs. I don't worry about them at all. What I worry about is those people who go for a period of time and then drop out of the program and never complete it, because there is no financial reward to some college. There's only financial reward to a completed degree or certificate program. And unfortunately, these loans will stay with these people for forever. If they're Department of Education loans, the federal government would have the ability to garnish tax returns and other sources of income to repay that debt. So that part troubles me, because a large segment of this debt is held by folks who never finish their degree programs. Okay, I mentioned earlier that debt was at an all-time high, but homeowner equity is now also at a new all-time high. And unlike the previous high, people are not able to get they're not taking their homes and turning them into ATMs. They are using the loans prudently to finance things, and lenders too are not wild about letting people ratchet up the debt. So we have a new all-time high on homeowner equity at a little over $14 trillion. To put this into context, U.S. households hold $11 trillion in cash and deposits at banks, and they've got $17 trillion held in stocks. In their retirement and pension funds, they've got about $30 trillion held in those accounts. So a lot of equity here versus the debt that we're holding. Net worth, again, is an all-time high, approaching quickly $100 trillion. So, again, I feel very optimistic about U.S. households. Okay, last question on this segment that I want to address is that we get a lot of questions about credit score distributions and what they're doing. So we presented here the December credit score distribution for the VantageScore 3 credit score. December of each year, looking at 2005, prior to the Great Recession, 2008. It was in September 2008 that the world fell apart, and many of the largest financial institutions were either on the ropes or failed. 2011, very close to the trough of the recession. The recession ended in 2009, but the unemployment didn't really bottom out until 2010. 2011 then represents that. 2014, kind of middle of the expansion, and now 2017. You can see that there's been a dramatic decrease in consumers with very low credit scores. They're what I'll call deep subprime, below the 560 mark. 10% of consumers now have a credit score in that range, versus in the very best range, the 800 to 850, we're now looking at about 23% of consumers, or 22% of consumers having scores in that range. So things definitely improving on the high end and decreasing on the bottom end. So again, that goes with an improved economy and all the other things we talked about. And the number of unscored has stayed pretty level. It's just a couple of percent of borrowers. Many of those are new to credit. They just don't have a deep enough credit file to be scorable. Okay, I'm going to finish up here with a quick discussion of origination trends before I hand it over to Gunnar. Last year, we saw first mortgages decrease a little bit as interest rates came up just enough to really stem the tide on refinance. But with a very tight inventory of homes for sale, we did not see home purchase really make up the difference, much to the consternation of those of us in the forecasting business who are forever optimistic that home sales will rise, really reflecting the demand for housing that we have, that the builders can't build it fast enough. Now there's apparently a lumber shortage, which will further decrease home production and increase the cost of building. So I don't see any change anytime soon in what's being built to accommodate the needs for not just homeowners, but just simply population growth in the U.S. On the home equity side, so the green top there is home equity installment loans. Those are often taken out as piggybacks when someone wants to avoid a jumbo loan or they want to avoid mortgage insurance. And although some people take them out separately just to extract equity. And then the home equity lines of credit, that's the HELOC there, now dominate. They've always dominated, but they're much stronger relative to installment loans today. Both of those are rising, but only modestly. Still less than $200 billion combined originated last year. HELOCs have the advantage of not being covered by the qualified mortgage restrictions that affect first mortgages and installment loans, so they're a little cheaper to originate. And that may be part of the popularity. However, you have to have very stellar credit to get a HELOC. We went ahead and looked at, this is a monthly chart, we went ahead and looked at the incidence of simultaneous seconds. These are loans that are taken out either at the same time at the closing table or within the month that the first mortgage is originated, often called piggyback loans. Sometimes the first mortgage lender knows about them and sometimes they don't. The worry is when they don't. And what we see here is that it's a very small number of loans. And in this case, you see, at least today, that home equity installment loans dominate these simultaneous seconds, but we're in about the 2% range of all loans, of these loans are simultaneously taken out with in the same month as the first mortgage. So nothing to worry about there. In terms of credit cards, we saw in 2017, again, this is a little preliminary because we won't have seen all of the November and December originations yet, but we're pretty confident in that the estimate here is close to the final answer. The 2017 saw a decrease in credit card originations and particularly bank cards. And then the private label retail cards on the right-hand side actually decreased for the second year in a row. So these are cards that are issued for use at specific retailers. On the left-hand side, you can see that the number of originations is about half of what they are of bank cards, and they represent about 10% of the balances of bank cards. They're a much smaller segment of the overall credit card market, but they've decreased for 2 years. And in both cases, subprime shares are down for these two segments, a little higher subprime share in retail card originations than in bank cards. But in both cases, those red lines dipped in the last year. Okay. Light vehicle sales, so cars and SUVs and other passenger vehicles. The forecast presented here is the average from the companies that are cited here. In general, there's a view that the pace will decrease. Some believe it will decrease just a tiny bit, and others have a little more bold forecast. There's still a huge demand for new and quality used cars out there, and so the substitute right now for obviously a new car is a car coming off of a lease or being sold out of a fleet, rental car fleet. And last year we saw an increase in used car sales. We've been seeing increases pretty steady. This is data from IHS Markit, formerly known as Polk data. And the anticipation is that in 2018 that cars coming off of lease, so we still have a significant amount of leases in play that have been originated in the last couple of years, that those will continue to provide quality alternatives for folks looking for new light vehicles. And you may have heard that the price of used cars is falling, that these lease vehicles are a problem because the prices coming in are low. And the answer to that is simply that the folks who issued those leases, the lenders that issued those and the car manufacturers, they had to take a guess on what the value of that car would be 3 years or 4 years out when that lease would terminate. And what those discussions was really relative to what they expected the values of those cars to be. And for a number of years, there were so few of these quality used cars that the prices were being bid up high enough that they had to cut a check to the consumer because those contracts are based on a residual value of the car when it comes back from the lease. In the last year, though, they had to turn around and take a loss on those cars because when those cars were leased, they were fuel-efficient sedans, and with the drop in oil prices, people went back to wanting giant SUVs, and so they had a hard time moving those sedans off the lot, and so hence the deep discounts. So regardless of what you think, you can look up these forecasts here if you want to formulate a range of those estimates. So down a little bit right now is the forecast in the neighborhood of about 2% for new car sales, and if trend follows, we should see a little bit of an increase in used car sales. On subprime auto, it started to decline 2 years ago. We saw a pretty steep decrease. They made up 22% of the accounts that were originated in 2017. This would be borrowers whose VantageScore 3 credit score was below 620. But total number of loans didn't decrease hugely. This is on the auto loan side, so total auto loans decreased just a little bit, again, relative to, we saw the sales earlier. About 50% of all car sales are financed, but the subprime share dropped dramatically. Look on the right-hand side, the gray bars, these are auto leases. So loans on the left, leases on the right. And leases already had a very small subprime share, and most of those are in the top segment of subprime. So in that 600 to 620 range, they're very picky about the borrowers that they'll take on the leases. And leasing decreased a little bit more than what we saw in auto loans. So leasing has cut back just a little bit. Okay, this is another way to look at subprime auto lending. So the prior one, I gave you the total share of all of the segments here in these bars below gray. But the dark black there at the bottom, we saw a decrease. The big decrease was in deep subprime, so loans below a 540 VantageScore 3 credit score. And that's been declining for a couple of years, but those percentage points really add up. That's a big part of it. So I think this is in part that there was a lot of news about how subprime auto lending was not doing very well, and some of that has to do with who's financing subprime. So if we look here, this is the share of the volume that these lenders did, origination balances by credit score. And as you can see here, banks, captive auto finance, these are the ones that usually have a manufacturer's name in their title. So, and they're a large segment of the market. And then credit unions, all three of those are very fussy about the kinds of loans that they originate, very low subprime share altogether, around 10% for credit unions, a little more for captives and banks. Independent finance are finance companies not associated with an automobile manufacturer, and they have a higher appetite for credit risk. And lastly, dealer finance are either lenders who finance specifically on their lot or who have a network of dealers that they work with. Sometimes some of these guys might be called buy here, pay here dealer finance, but other ones are more broadly, they serve a network of dealers more specifically. And in those cases, they have a much bigger appetite for higher risk credit score borrowers. Interestingly here, independent finance makes up 4% of all of the lending, and they are the only group that increased their share of deep subprime. So total deep subprime declined. These guys here, independent finance, took on just a little tiny bit more. And let's go to the next slide here. So you can see here that banks actually decreased broadly their share of auto lending. So in 2016 Q4, they were 39% of the market share. Now they're down to 34%. We saw captives take up some of that room, and credit unions gain some of that. The smaller guys, independent finance, dropped just a little bit, 0.2% of market share, and dealer finance stayed constant at 1%. So who's doing the lending and their tolerance for risk has dramatically changed. So now I'm going to hand it over. Gunnar, what do you have to say about the performance of auto loans?
Thank you, Amy. auto loans is a great place to start looking, as we've had a lot of questions in that space lately, partly because of what you mentioned in terms of the shift from a new car market to a used car market and how that's changing performance. It's also interesting to look at from a bit of a deep dive perspective. So we have an opportunity to look closer at loans versus leases. We have an opportunity to look closer at the various dealer types and what they're doing. So this is the typical overall performance chart that we get from Credit Trends, where we are looking at performance for the total outstanding portfolio. Auto loans are on the left, auto leases are on the right. We see that 2017, both for loans and for leases, we've gotten a slight improvement relative to 2016. It's also important to look at this in context of the entire series here. The increase really was coming off of a low in 2011 with very, very tight underwriting criteria. And even when you compare back to 2007, 2008, the 2016, 2017 is historically very low, so very good performance. And if you recall back in the recession, auto loans were actually the ones that consumers were prioritizing over other debt. So even though 1.4% seems high for auto loan, that was actually not where the worst delinquencies were. And so when we're looking at a 1.1% now for auto loans, or a 0.45% or so for auto leases, that's actually historically a very, very good performance. We have a slightly different view that we can present. This actually requires us to go a little bit closer back to the data and roll it up in a different way that we can't do with our regular Credit Trends product. You can get similar results to this using creditforecast.com, and we also have a new analytic data set that allows you to do this from a low-level data set that we just announced a few days ago. So what we're doing here is basically we are rolling it up by months on book. Each line in this chart, all the little gray lines, is a quarter of originations. So for instance, and they're not labeled because we just wanted to give you an idea of the cloud of different potential performance. We've labeled the outside extremes. So the red stippled line is the worst performance we've seen. The green stippled line is the best performance we've seen historically. And then the blue lines show 2015. The purplish lines show 2016, and the orange to yellow line shows the most recent year. And on the y-axis, we plot cumulative non-performance, which is basically cumulatively who have gone to 60-plus days past due or have exited in a default status or a bankrupt status. So it's similar to an ever 60, if you're more comfortable with that concept. The difference is not that big. The only difference is that this allows somebody to cure out of the 60 and then not be counted in that line. So it is possible that some of these lines actually can dip down. So what we really see here for auto leases is that the orange and yellow lines are following fairly closely the purple lines. So over the last few years, that performance has been fairly consistent early on. Obviously, it's still at 0 2 months in because you can't get to 60 plus in less than 2 months. So that's why those loans will be hugging the axis until month 3 or so. This is showing the same thing for auto loans. And so here we see that there's a little bit less of a gap from the worst performance, which we saw back in 2007 Q1. But we are still following fairly closely the trend that we've seen over the last 2 to 3 years. We're actually slightly better off here. The orange line is actually slightly better off than the purple line. So we're seeing slight improvement on the overall performance for loans. If we look at it, go drill down a little bit closer. This is showing the same, but for subprime auto loans. So loans with a VantageScore of less than 620. There we see that we are in fact following the worst performance much more closely. So the really truly subprime loans are back to that risk profile that we've seen back before and during the recession. That's not necessarily a bad thing because subprime is a second chance for very many borrowers, and what we've actually seen is basically more of a risk appetite for lenders to go in and service that particular space. So even though performance is mirroring what we saw back 10 years ago, it's a small segment of the overall population, and it's a risk that's relatively well handled. The volumes over on the right here, the colors in that are set up so that they match the lines on the left. So the orange to yellow lines bars show the 2017 quarters 1 through 4. The dark red and the dark green bar mirror those 2009 Q3 for the best performance, 2007 Q1 for the worst performance. So this shows for subprime auto leases, which generally fare better than subprime auto loans, but there are relatively few of them. Subprime is not an area that is very frequently used for leases. We did have a question a few days back about whether we have noticed an uptick in dealer finance using leases for subprime loans. And we went and investigated that, and we did see about a doubling of the lease penetration in that space from 3% to about 6%, and then a slight pullback. In context, the lease penetration for the captive auto finance, so the ones that are branded by a particular car manufacturer, is up and around the mid-40s, mid-40% range. So even at 6% or 5% penetration for leases in dealer finance, that's still a pretty low number. We can drill down a little bit further and look at this in the context of credit score. So here we basically show for two very narrow bands of prime consumers, so 660 to 679. That's well into the prime range, but it's a narrow band which really allows us to see similar consumers, or at least in terms of credit score, similar consumers. What it really bears out is that there's a lot more to underwriting than just credit score. You notice a big difference between credit unions' performance, the green line at the bottom, to the other end of the range, the dealer finance performance, even for the same credit score borrower. That is kind of a two-way street, of course. If you get dealer finance, the terms that you get on dealer finance are typically not very favorable. And so that will drive up your payments and will increase the likelihood of defaulting on that type of a loan. On the other hand, if you could get something other than dealer finance, then that would probably make you a better risk, and so your performance would be expected to be better. What I like about this graph is that it shows really, it's very consistent from the right to the left. So when you go to the 620 to 639, the pattern is extremely similar. Go ahead, Amy.
I was going to say, it's important, I think, that each of these types of lenders, whether we're talking credit unions who serve, a member community that's very specific, or dealer finance, each one of these lender types, really does specialize in a niche in the market.
Yep, and I think the same when you also then go down into the subprime and the deep subprime range, which is pictured here, 600 to 619, just under our subprime cutoff, versus 520 to 539, which is really pretty deep subprime. You still see the same pattern. You see that the lines get compressed a little bit, particularly between that independent finance versus dealer finance. So there's less of a difference. Of course, that's because you are up in the 20 to 25% default range within the year. So the cherry picking is harder to do in that space. And there are borrowers who can get a deep subprime loan from a credit union. Obviously, it's not something that happens very often, and when they do, it's very much a relationship-based model where they have a lot more information to do the underwriting for those borrowers than what you would get if you walk onto a dealer lot. So let's take that same model and try to apply it to some of the other areas that we've found interesting results. Credit card performance worsened over 2017. Again, this historically, we should put this in context and say that this, 2017 bank cards versus 2006 bank cards were actually still at a much better performance level than we were pre-crisis and certainly through the crisis. So even though it's ticked up a little bit, that's not a huge concern to us at this point. On the private label retail cards, that performance has also deteriorated a little bit. It's closer to the historical worst than it is for the bank cards. So there's a little bit more of a concern in that area, which we will address in the next few slides. So bank cards, truly following sort of the middle of the pack trend. The orange line really following the purple line, saying we are pretty much where we were last year in terms of performance, maybe slightly better, but historically we're right in the middle of the pack. That holds up also if we go to subprime. So subprime actually in terms of bank cards looks almost better than the prime performance overall, relatively speaking. Obviously the performance as a whole is worse, but relative to historical performance, the subprime is holding up very, very well on the bank card side. On the retail card, private label cards, so basically store-branded cards that you can only use in that chain of stores, that performance is looking much closer to what our historical worst has been. In fact, the historical worst there that we're comparing to is 2014 Q4. That's the vintage that really was troubling. And then the last few years have actually been slightly worse than that, with the orange line basically hugging where we were last year in 2016, and actually slightly worse than where we were in 2015. And that driver of that is really on the subprime side. I'm going to skip to just quickly talk about consumer finance. We consumer finance is a little bit of a mixed bag in terms of both installment and revolving accounts with very different terms, with very different sources. The performance here is interesting from one perspective in that the lines tend to go up really steeply, really quick, but then flatten out. So a certain subset of this portfolio is going bad fairly quickly, but then overall consumer finance is not a bad sector to be in. And that's probably driven a lot by the online lending, marketplace lending, where they're using alternative criteria to do the underwriting, and it's driven a lot by consolidation of higher interest debt, which can actually help the consumer manage the balance sheet. We'll finish this out a little bit with mortgage. That is one of the bright spots. We've seen that come back to basically 2006 levels across the board, both for first mortgages, for home equity loans. We're almost there on the home equity lines, with the last of the 2007s hitting recast in 2017, and a few the tail end of that wave, the 2008s hitting recast early this year. We should see that come down even a little bit into closer to historical best performance. And looking at it in terms of the months on book performance by vintage, we can see that the recent vintages are really performing excellently, better than the best we have seen historically back in 2013. In fact, the little bump there on the 2013s may relate to that in order to get a modification, you had to go 60 days late. And so you can see some of that eventually cured when they did get their modifications. I believe that's all I'm going to be able to cover today. So, Teresa?
Yes, thank you, Gunnar, and thank you, Amy. As expected, we had an overwhelming amount of content to share with you today, so unfortunately we won't have time to take your questions on the line. However, as I mentioned at the beginning of today's presentation, we will send a follow-up email in about 2 weeks that captures your responses in an FAQ type format. Now, upcoming, a quick heads up to save the date for our upcoming webinars. Our second quarter webinar will be on May 17th, and then Q3 and 4 are scheduled for August 21st and November 15th, respectively. You'll get an email about 1 month prior to each webinar, and it will include the registration details for you. Now, just really quickly, we do invite you to explore additional resources that are available on our website, including our all-new U.S. National Credit Trends Reports. These are published monthly, and they're available through your Equifax account manager, so definitely reach out to your account manager if you're interested in seeing a deeper level of detail. Also online and updated quarterly is a shorter report with accompanying Excel files that contain all of the chart data from that report. It contains the most timely originations data available, and it's estimated through quarter just ended. It's posted on our investor relations site immediately after our earnings report is made public. Finally, we've published the latest in a series of studies available on our investor relations webpage at investor.equifax.com, focusing on recession risk. There's also a complimentary ebook, and it will highlight key facts on the recession outlook, and these resources are available on equifax.com. We also invite you to follow us on our Insights blog as well as on LinkedIn and Twitter. For additional information or to learn how your company compares to peer, please reach out to your account manager today or visit us online at equifax.com/business/credit-trends. It was our pleasure to share this information with you today, and as most of you are aware, Equifax is a global information solutions company. We use unique data assets, technology, analytics, and expertise to deliver information and create unparalleled insights through our customer-centric approach, flexible delivery methods, and scalable global platforms. On behalf of Amy, Dinar, myself, and the entire team here at Equifax, I want to thank you again for your time and for joining us today. We hope you found the information worthwhile and that it has provided you with the kind of insights that will help you drive improved strategic decisions. We look forward to working with you in the future, and thank you again for joining us. That does conclude today's webinar. You may now disconnect.
Thank you. Please stand by.